This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
So along came, because of these failures, the government in the UK, the government said to this man Adrian Cadbury, can you identify the causes of these failures and prepare a report? It's called the Cadbury Report because Sir Adrian Cadbury was the chair of the committee that looked into the reasons for these failures. And any report, and we're going to come across a number of them, a number of these reports, they're all named after the chairman. This Cadbury, the Cadbury family, is a very famous family of chocolate manufacturers, the Cadbury's chocolates, and he was the chief executive of the Cadbury company. So 1992, the Cadbury Report came out. This was then followed by Greenbury Report on directors' remuneration, then Hampole, and these were combined into the Combined Code, the first of the Combined Codes. Then in 2003, the Higgs Report about the effectiveness of non-executive directors. Turnbull followed that in 2005. 2006, we've now incorporated Higgs and Turnbull into the Combined Code, and so the 2006 Combined Code is, so far as I'm aware, it's the most recent version. It applies to all UK quoted entities, which must state how they have applied corporate code principles. They must state that they have applied corporate code principles throughout the year, and if they haven't, then they must give a detailed explanation of how and why they haven't applied. Again, if you read Campbell's articles from the beginning of 2009, one of his articles gave two examples, or three examples, of companies which had failed to apply the Combined Code principles throughout the year. Some of them go into the very fine detail. One of them, I seem to remember, one of them said that they did have one director whose compensation for loss of office was going to be 2 years' salary, whereas it should only be 1 year's salary according to the Combined Code. Another one had specified something rather more important or rather more dramatic than that. The rules-based approach in page 13, the USA passed their legislation Sarbanes-Oxley, or SOX as it is affectionately known, and again it applies to all US quoted companies. But interestingly, it applies, and this is, I don't know, is this Americanization? Is this Americans wishing to dominate and influence the world? The Americans say, if it's a public quoted company, and it has subsidiaries anywhere in the world, then those subsidiaries anywhere in the world must also apply the principles of Sarbanes-Oxley. Sorry, the rules of Sarbanes-Oxley. So some of you auditors probably do come across subsidiary companies in your country which are subsidiaries of American parents, and they have to apply the rules.
Actually, for us too.
Tell me again.
I work for Wellful, it's American.
Yeah, and is there a parent company in the US? So you also are bound by SOX?
Yeah, we are asked to sign financial statements every quarter.
You're asked to sign a compliance statement?
Yes, that's
Yeah. And if you sign it and it's wrong, and the company has to restate its financial statements in a material way, the directors, the chief executive and the chief financial officer, must repay to the company any bonus that they had received in the previous 12 months. So it hits these directors in the pocket. If they sign financial statements as showing true and fair view, and it subsequently is necessary to restate those financial statements, then these directors have got to dig into their pocket and pay back their bonuses. So it's a personal attack on the wealth of the individual directors who apparently appear to have been negligent. The main provisions of SOX, it's only the main provisions, I've not gone into any major detail. All quoted entities must provide a certificate to the Securities Exchange Commission. That's often abbreviated to the SEX or the SEX Commission, but I don't know whether that's just my abbreviation or not. So we must provide a certificate to the SEX Commission, the SEC, confirming the accuracy of the financial statements. And if they have to be restated, oh there we are, any bonuses received in the previous 12 months must be repaid. Auditors are restricted to audit work. They're not allowed to provide accountancy work, secretarial work, trust work, recruitment work. Tax they can, because tax is seen as being an integral element of the financial statements, and the best people able to compute tax computations are likely to be the tax departments of the auditors. So it's inconceivable that the auditors should not be allowed to perform taxation services. But all the others, no, you can't do it. You can with de minimis limits, up to a very low amount, so long as you have the permission of the audit committee. But otherwise, auditors are restricted to audit work. The senior audit partner must rotate off the audit after no more than 5 years. It's not seen as a good thing for auditors to remain in office for extended periods of time. The Italians tried an experiment where auditors had to resign after a 3-year service period, and so every 3 years the auditors would change. And the Italians recently, within the last 12 months, have declared the principle that says this is not working, this is not a sensible thing to do. If you think about it, you can see it's not sensible. If I appoint, let's say I appoint Aldis's audit firm here to be my auditors, the first year that Aldis's firm is going to audit my company, the first year is bound to be the most expensive. It's bound to be, in terms of time alone, because they have to find out about the history of the company, about the systems, the policies, the structures, the products, the competitors, the share capital structure. They've got a lot of work to do when taking on a new audit. The second year is a lot quicker, and the third year quicker still. But then the Italians are saying, right, having paid for the expensive one and 2 more, then we're going to stop there and bring in Yanis's firm, and Yanis is then going to incur the same expense. So it's a phenomenally expensive operation. Who bears that expense? Who pays for that expense of expensive auditors in the first year? But the auditors, maybe in terms of overtime, that they're having to give up their lives in order to work the overtime. No, but who pays the money to pay for this expense? Well, actually, yeah, but not ultimately. Not ultimately either the shareholders. Maybe the shareholders if the company. Surely the company will pass this increased cost on to the public. They will increase this is another expense, therefore we need to build it into our pricing structure. And therefore, it's me. I'm having to pay for Yanis having taken over from Aldis. It's me that's having to pay. Me and you, the public. So it's not work, and the Italians have now given it up. I did come across a student, maybe 12 months ago, who said we change our auditors every year. Every year they change their auditors as a matter of company policy. I can't understand why. And well, you can, because it prevents the auditors from becoming too familiar with the company, and therefore they ensure an independent view is being taken of the company's systems, controls, financial statements, honesty. It brings this independence back into the forefront of the company's mind, and the shareholders are therefore better secure because we have a fresh pair of eyes looking at the situation. But I can't believe that it's financially sensible. But every year they change their auditors. Do you? No. How long have your auditors been auditing you?
We have been auditing 10 years, I guess.
10 years? Do you not think that might be a little bit too long? I mean, I'm not suggesting, and particularly if your auditors are represented in the room, I'm not suggesting that you should say to your directors, do you not think it's time we change the auditors? And people like Agnesa here, where she works for a subsidiary of a big group, then it will be group policy to have the same auditors throughout the group. So even if Agnesa stands on the table and shouts at the directors, it's not going to have any effect. But it does mean that your auditors, who've been, probably the senior auditor has been coming back there for 3, 4, 5 years, and auditors expect to see what they normally see. And if you've been going back to the same client for 3 or 4 years, you get into a routine. And I have to do this, and then I have to do that. And they don't bring this fresh pair of eyes, this fresh attitude. And that then is a threat to their competence, because they are prejudging what they expect to find, and therefore they will possibly only find what they expect to find. And therefore it is a good idea to change your auditors, but not every year. And this pre-penultimate point there, the senior audit partner must rotate off the audit after no more than 5 years. That also is a good point. Even if your auditors have been auditing you for 10 years, you should by now have changed your audit partner. You're in line actually for a second change of audit partner, because that brings a fresh pair of eyes to the review process. The problem is, if you've only got one partner or two partners in the office, then it's difficult to rotate a partner off.
Actually, we have this restriction.
You do have this. You do rotate your partner off. Excellent. What about you, Aldous? Your firm the same? Yeah? Good. The Public Entity Oversight Board is something created by Sarbanes-Oxley, responsible for enforcing professional standards and account. And this Public Entity Oversight Board, it's a board of 3 people. They have lots of employees, but the board is 3 people. And one of them should have recent financial experience. But the other 2 don't have to. And so you've got this Public Entity Oversight Board comprising presumably competent people, and they're employing lots of other people. And their role is to make sure that public companies are complying with the Sarbanes-Oxley rules. So they will send their employees in and they'll get the checklist and tick it off and say yes, they have complied, or no, they haven't. So those are the main, or some of the main principles. Oh, there's one there, isn't there? Directors are forbidden from dealing in company shares during sensitive times. When is a sensitive time? When's a sensitive time in the context of companies and reporting? It's after the year end, but before the publication of the results, isn't it? Or even half years or quarter years. Some of our companies in the UK have to report on a quarterly basis. So between the end of the quarter and the publication of the results, that will be a sensitive time. These people, directors, by definition, they satisfy the definition of the word insider. And if I use the word insider in the context of insider dealing, these are people directly connected to the company, who, as a result of their connection, as a result of their relationship with the company, they are likely to be in possession of a type of information which is called unpublished price-sensitive information. And for a person who is an insider, and therefore has unpublished price-sensitive information, then to deal in that company's shares, to buy or sell, to make a profit or avoid a loss, that is a criminal offence. That carries up to 2 years in prison. So it's an offence under Sarbanes-Oxley, for directors to deal in the company's shares during sensitive times. It's clearly in the UK a statutory offence. It's within law for directors to insider deal to make a profit or avoid a loss. They can deal, and even though they are insiders, but they can only deal on the basis that it's a normal transaction, or they're selling their shares to raise money because they need it for something else, and they mustn't do it, therefore, purely with the intention of making a profit or avoiding a loss. Page 14, the OECD and the ICGN, International Committee of Corporate Governance, International Corporate Governance, International Corporate Governance, I've forgotten the N. The OECD, Organisation for Economic Cooperation and Development, these have both issued principles on corporate governance. The idea of their documentation that they've issued is that they are principles. They are a guide to assist directors to comply with the combined code. That's why they've done it. The principles serve multiple purposes, though. They assist governments in their efforts. So any difficult to pick on a country without insulting the people of that country. But if I pick on Burma, for instance, then it would assist the Burmese government to introduce corporate governance principles. Provide guidance and advice to regulatory bodies such as the stock exchanges, investor groups and institutions. And although aimed directly at listed companies, it's recognised that any and all companies could sensibly benefit from the application and the adoption of corporate governance principles. But they have no legal status. It's what we call, the expression we would give it in the UK would be, it's a toothless tiger. It's a tiger with no teeth. A toothless tiger. It looks vicious with its red hair. It looks really vicious, this toothless tiger, but it has no bite. A summary of the OECD principles. Identification of the basis for an effective corporate governance framework identifies how it could sensibly be created, this framework could be done. It's fair treatment for all shareholders and for all stakeholders. Fair treatment for all. It identifies the rights of the shareholders and the rights of stakeholders, whether you recognise them or not, whether you know them or not, whether they're narrow or wide, internal, external, active, passive. Whatever they are, it recognises the role of stakeholders and the rights of stakeholders. It details disclosure requirements and transparency arrangements. Establishes key ownership functions. Key ownership, the big investors, the ownership, the shareholders. It establishes what they should do with reference to the compliance with the principles of corporate governance. And establishes also the board's responsibilities. The ICGN, similar, identifies corporate objectives of providing returns to shareholders. This is what companies are there to do, isn't it? They provide what's called TSR, total shareholder return. How would you measure, how would you describe, or what is comprised in the expression total shareholder return? What's involved in that? If you're a shareholder, you've invested money in a company, what would you expect your return to be comprised of? The value of your shares increasing is certainly one element of it. The other element would be dividends, the dividend stream. So this establishes and identifies that the company's objective, any corporate objective, is surely to provide total shareholder return. And in doing this, in identifying that this is the objective, then companies should pay attention to disclosure and transparency. Independent audit. Again, this one details the shareholders' ownership, responsibilities, rights and remedies. Identifies detailed provisions relating to the boards of directors in terms of how many directors there should be, how many executives and non-executives, what their characteristics should be. It prescribes board remuneration policies. One of the major elements of a remuneration committee is that it's the remuneration committee's policy. This is written down in later notes, so there's no need to write it. It's the remuneration committee's policy, or the company policy, to attract, retain and motivate directors of appropriate competences. To attract, retain and motivate. And therefore also to pay them on the basis of the performance that they achieve. Provides guidance on how we can implement corporate governance principles, and prescribes social awareness. This is a big area, this prescription of social awareness, and recommending the entity-stakeholder relationship and establishing the need for business ethics. These are big areas within the P1 paper. Social awareness, corporate social responsibility. Does a company have a corporate social responsibility? Does it have a social responsibility? Does your employer acknowledge its... I'm not even going to ask, does it have a social responsibility? The answer is yes, it clearly does, because all companies do. Does it acknowledge your social responsibility? And do they actively pursue this socially responsible attitude and approach? Yes, they do. Yes, of course they do. Of course they do.